The shooting star bearish pin bar. The shooting formation is formed when the open low and close are roughly the same price. This candle is characterized by a small body and a long upper shadow. It is the bearish version of the hammer. Professional technicians say that the shadow should be twice the length of the real body. See the example below. The illustration above shows us a perfect shooting star with a real small body and an upper long shadow. When this pattern occurs in an uptrend, it indicates a bearish reversal signal. The psychology behind the formation of this pattern is that buyers try to push the market higher, but they got rejected by a selling pressure. When this candlestick forms near a resistance level, it should be taken as a high probability setup. See another example below. The chart above shows a nice shooting star at the end of an uptrend. The formation of this pattern indicates the end of the uptrend move and the beginning of a new downtrend. This candlestick pattern can be used with support and resistance, supply and demand areas, and with technical indicators. The shooting star is very easy to identify, and it is very profitable. It is one of the most powerful signals that I use to enter the market. In the next chapters, I will talk about it in details, and I will show you step by step how to make money trading this price action pattern. Harami pattern. The inside bar. The harami pattern, pregnant in Japanese, is considered as a reversal and continuation pattern, and it consists of two candlesticks. The first candle is the large candle. It is called the mother candle, followed by a smaller candle which is called the baby. For the harami pattern to be valid, the second candle should close outside the previous one. This candlestick is considered as a bearish reversal signal when it occurs at the top of an uptrend, and it is a bullish signal when it occurs at the bottom of a downtrend. See an example below. As you see, the smaller body is totally covered by the previous mother candle. Don't bother yourself with the colors. The most important is that the smaller body closes inside of the first bigger candle. The harami candle tells us that the market is in an indecision period. In other words, the market is consolidating. So, buyers and sellers don't know what to do, and there is no one in control of the market. When this candlestick pattern happens during an uptrend or a downtrend, it is interpreted as a continuation pattern which gives a good opportunity to join the trend. And if it has occurred at the top of an uptrend or at the bottom of a downtrend, it is considered as a trend reversal signal. Look at another example below. In the chart above, you can see how the trend direction changes after the harami pattern formation. The first bullish harami pattern occurred at the bottom of a downtrend. Sellers were pushing the market lower. Suddenly price starts consolidating, and this indicates that the selling power is no longer in control of the market. The bearish harami is the opposite of the bullish. This one occurred at the top of an uptrend, indicating that buyers' domination is over and the beginning of a downtrend is possible. When this pattern is created during an uptrend or a downtrend, it indicates a continuation signal with the direction of the market. We will study in details how to trade this pattern either as a reversal pattern or as a continuation pattern in the next chapters. The tweezers tops and bottoms. The tweezers top formation is considered as a bearish reversal pattern seen at the top of an uptrend, and the tweezers bottom formation is interpreted as a bullish reversal pattern seen at the bottom of a downtrend. See the example below. The tweezers top formation consists of two candlesticks. The first one is a bullish candlestick followed by a bearish candlestick. And the tweezers bottom formation consists of two candlesticks as well. The first candle is bearish followed by a bullish candlestick. So we can say that the tweezers bottom is the bullish version of the tweezers top. The tweezers top occurs during an uptrend when buyers push the price higher. This gave us the impression that the market is still going up, but sellers surprised buyers by pushing the market lower and close down the open of the bullish candle. This price action pattern indicates a bullish trend reversal, and we can trade it if we can combine this signal with other technical tools. The tweezers bottom happens during a downtrend. When sellers push the market lower, we feel that everything is going all right, but the next session price closes above or roughly at the same price of the first. Bearish candle, which indicates that buyers are coming to reverse the market direction. If this price action happens near a support level, it indicates that a bearish reversal is likely to happen. The chart above shows us a tweezers bottom that occurs in a downtrend. The bears pushed the market downward on the first session. However, the second session opened where prices closed on the first session and went straight up, indicating a reversal buy signal that you can trade if you have other elements that confirm your buying decision. Don't focus on the name of a candlestick. Try to understand the psychology behind its formation. This is the most important. Because if you can understand why it was formed, you will understand what happened in the market, and you can easily predict the future movement of price. Candlestick patterns exercise. Now I think that you get some information about Japanese candlesticks. You know the anatomy of each candlestick and the psychology behind its formation. Let's take this exercise to test your knowledge and see if you still remember all of the candlesticks we talked about. Look at the chart below and try to find the name of each candlestick number and the psychology behind its formation. If you can easily identify these candlestick patterns, and you understand why they are formed, you are on the right path. But if you still struggle to identify these patterns, you will have to start learning about them again till you feel like you master them. Try to answer the questions concerning the candlestick patterns on the charts above. 1. Bullish harami pattern inside bar. The formation of this candlestick patterns indicates indecision in the market. In other words, the market was consolidating during this session. 2. Bullish tweezers. The market was trading up. Sellers tried to push the market lower, but the reaction of buyers was more powerful. This pattern represents the battle between sellers and buyers to take control of the market. 3. Engulfing bar. Sellers were engulfed by buyers. This indicates that buyers are still willing to push the market higher. 4. Engulfing bar. 5. Engulfing bar. 6. Engulfing bar. 7. Harami pattern. This pattern shows us that the market enters in a consolidation phase during this session. So buyers and sellers are in an indecision period. And no one knows who is going to be in control of the market. Let's take another exercise. Look at the chart below and try to figure out these candlestick patterns. Answers. 1. Bullish engulfing bar. 2. Hammer. 3. Sad face hammer, which is the large body plus the smaller body baby, equals harami pattern. 4. Bullish engulfing bar. Please, I want you to open your charts and do this homework over and over again. You will see that with screen time and practice, you will be able to look at your charts and understand what the candlesticks tell you about the market. Don't worry about how to enter and exit the market for the moment. Take your time and try to master the candlestick patterns discussed in the previous chapters. In the next chapters, I will arm you with techniques that will help you identify the best entry and exit points based on candlestick patterns in combination with technical analysis. Trust me, these price action strategies will turn you from a beginner trader who struggles to make money in the market into a profitable price action trader.